Okay, good morning, good afternoon, good evening, everybody, depending where you are around the globe. I appreciate the time and the chance to connect with you to do module 2 of the options course. So in this module, we're going to talk about pricing. Now, as I said in the email, I know that does not seem to be the most exciting conversation because it really goes typically one of two ways. Either we can get really into the math, and when I did my finance degree, I took a derivatives course, and we took weeks and weeks and weeks and drilled down into exactly how futures and options and derivatives are priced. And that was interesting, but frankly, it doesn't really have a lot of connection to trading. The other way that pricing is typically taught is here's a web page, go put in these factors and you'll get an option price out. So it's just a calculator. I think that both of these approaches really miss something very important. And that's what I hope to give you today. The bottom line is we're going for intuition in understanding option prices. So to do this, here's just kind of an outline of what I hope you come away with today. We're not necessarily going to do all of these things in these orders as topics, but in this order as topics, but here's what you should have at the end of the session. I want you to know what really matters in pricing an option. We'll look at some things that don't matter so much, but I want you to know where you really need to focus. They're really just a handful of things that are by far the most important. And you also need to understand why those factors are most important. And we'll touch a little bit on some of the more out there things that have a very minor influence, but only enough so you understand why the things are so important. And then the other thing that is many times relegated to curiosity is the assumptions behind the pricing models. I think these are incredibly important because if we understand the assumptions, then we have some better idea how we might make money. And that's very interesting. So that's what I hope to do today. Not so long ago, nobody really knew what an option was priced or what an option should be priced. You know, in the US, if you go back to the very early 70s, this was before anybody knew what the Black-Scholes model was, and options were traded, but literally the way these things were traded was you would call somebody on the phone and you would say, hey, I want to buy a X dollar call on IBM that expires in 60 days. They weren't listed, especially at first. You know, there was no option grid you could go to. You just had this conversation with somebody and they quoted you a price and you decided to do or not do the trade at that price. And of course, in this environment, as you can imagine, mistakes were made. And a lot of people did very well, and a lot of people got hurt. And this really was the wild, wild west of option pricing. You can imagine if you pay too much or too little for an option, either one is bad. If you are, let's say you're selling options, you're writing options, if you charge too much to give people the other side of the trade, then nobody's going to trade with you. And there simply will be no volume in the product and it will go away and die. On the other hand, if you're selling options and you charge too little, you won't be able to cover your risk and you eventually will go out of trade. I'm sorry, you will go out of business. It's a little bit early here. My brain is a little slower than usual. So the goal of all of this is not to find some magic price that lets you take money away from somebody else. And that really was an aha moment for me. When I started studying options, I thought, okay, we're going to figure out like what everybody else is missing, and we're going to be able to see things that the market misses and basically take money from a lot of people. But that's not really the intuition behind option pricing. The idea is that we're looking for the right price, we're looking for the fair price, and we're going to come back to that in a minute. So here's a simple, not so simple problem. Stock XYZ is trading at $100. What would you pay for the $100 call? So imagine you were on the other end of that phone. You're sitting there at your trading desk back in 1973, and the telephone rings, and the guy says, "Hey, I want to buy the $100 call on XYX, I guess the stock is. And what price do you quote this person?" Well, it seems to me we probably need more information, but think about that. And a lot of times you see examples like this in seminars or in books, and it's very easy just to read past them and get to the next slide, or to say, okay, yeah, you're going to tell me more things, but after this presentation is over, make a note. Please go back and do this exercise. Really try to puzzle through this from the perspective of that trader who has no information to work on. You've never heard of Black-Scholes. You don't know what volatility is. These are things we're going to talk about today. But just from those first principles, think about how you would price this call. And I would suggest that's a not so simple question. We're going to spend most of an hour today talking about this. However, this question is simpler. Of these scenarios, which one is worth more? Remember, the stock is at $100. It doesn't really matter so much, but which would you pay more for if you were buying an option? Would you pay more for the $100 call or the $110 call? And I don't think, and again, I'm assuming if you're here for this session that you understand what a call and a put is, where that was covered in the first session. If you don't know that, this is probably going to be kind of hard going. So, but that's really all the information that you need to have. So if you imagine that in the almost any scenario, in fact, it's basically impossible, this is the one that would be worth more. So in all cases, you would end up paying more for the $100 call. Would you pay more for a call that expires next year, that has a lot of time left, or from one that expires tomorrow or today? And one interesting trick with all of this stuff is to kind of take it to, if not to the limit, at least to extremes. If we're talking about an option that expires in 34 days and one that expires in 45 days, well, you can kind of get some sense about that. But if you go crazy and you say next year or 10 years from now even, or one that expires tomorrow or even today in 5 minutes. So yeah, those would be really extremes. One that's right at expiration, one that has a lot of time. Then it's easier to see that even if we don't understand why, it's pretty clear that the option with more time left is worth more. And how about, here's one that's a little bit more abstract and a lot harder to talk about. In fact, our next module in this course, we're going to just focus on what we mean here by bouncing around a lot. But we can also see that if you have a stock where you look at the chart and it kind of trades like this, as opposed to a stock that trades like this, that this scenario where it bounces around a lot, this is the option that is worth more. And thinking about that, thinking about why these things should be true, we begin to realize that what we pay for the option is really about what we don't know. It's really about uncertainty. Now, what do we know? Okay, so if you have looked at any book on options, you've seen a lot of what we call hockey stick diagrams. So they're diagrams like this, right? This is what people think a call payoff looks like. And this is what it would be to be short the call. There are all kinds of these. There's a put. Those are, by the way, they're true and they're valuable because they show what the option is worth at expiration. They're not really enough to trade options. And that's one of the places that a lot of the books make mistakes. Even a lot of finance courses will really focus on those hockey stick diagrams at expiration. Now, expiration is incredibly important because expiration is the moment where you truly know the value of that option. and the value is the moneyness or lack of. You know, if the strike is out of the money and the option is expired, well, would you execute the option? You know, that's the question. Would you exercise the option? And the answer, of course, is no, because you would lose money doing that. Why would you buy a stock higher than the current price if it's out of the money? And if it's in the money, then if you execute the trade by exercising the option, you will instantly make the money. So you know at expiration what it's worth. Before, it's all about the uncertainty. And so what it really comes down to is understanding what are the chances of, if I buy this option, something good happening to me, right? That's really on an elementary level what we care about. If the stock is at $100 and if I buy this call, what is the chance of the stock going up? And we have to say chance or probability because, of course, it could go down. And you also need to, another key intuition, which I think is probably not such a leap for some people, for most people, is that for every option that you buy, somebody sells it to you. And vice versa. For every option, if you were an option seller, for every option you sell, somebody bought that option from you. And while it is a mistake to assume that that person basically wants to do the other side of your trade. Do you understand what I mean by that? Like, that's one of the, particularly with technical traders, it's one of the big mistakes. You know, you'll come up with your super secret wave methodology with your ratio moving averages and cycles. And so you'll do your analysis and you'll say, okay, when this is like a really great spot to buy the market. Anybody who doesn't see this is stupid, and why would somebody take the other side of my trade? Or the idea that, you know, every time you go long, somebody goes short. Well, it's obviously not true, and I don't want to get sidetracked on that. That the person is not necessarily doing the other side of your trade, but they are going to have the other outcome. So what is good for the call buyer is bad for the call seller. And this is why, and neither one of these people, this goes back to what we touched on in the first module, you know, you assume that and you assume for very good reasons, that the people who are trading in the market are smart. So there are no dumb traders. They're just going to hand you out money. Dumb traders are quickly eliminated. We're all dumb traders when we start. I certainly was. Yeah, but you have two paths. Either you become a not so dumb trader or you stop trading at some point. So there really aren't people in the market just standing around waiting to give you money. If you're going to make money, it's going to be because you do trades that are fair and both sides agree that the price is probably right. Now, I'm hedging a lot here, right? I'm using a lot of language that involves probably. We'll talk about that in a minute. But from this, you can also see that one of the keys here, and one of, you know, I've done this myself long enough and taught it enough times that I know the places people get stuck. And it's very, very easy to get stuck thinking about a specific outcome. And you can't do that. I understand that you have just done deep technical analysis on stock XYX, or you got a great tip, or you got a great signal from your technical system. And in this particular case, you are, quote, sure that this is going to happen, or at least you have a very high degree of confidence. And so it can be a little bit hard to see past that, especially if you're a newer trader, and by that I would say trading less than 5 years, and you still have a lot of emotion and ego tied up in trades. And that's not a criticism. I'm not, but the goal is to move past that to kind of a selfless place where you see with objectivity. And one of the ways you start to see with objectivity is you think in large sample sizes. This is not about this one $100 call on XYX we're talking about. This is rather about doing essentially the same trade hundreds and hundreds and hundreds of times. And so it's about what happens over a large sample size. Now, that happens to be true about whatever kind of trading you're doing, but particularly when we think about option pricing, is really important. Now, an interesting thing is, we tend to think about options as being kind of cutting edge, at least in the history of 20th century finance, definitely coming in the last half of that century, the last quarter of that century, really. And if you start to do a little bit of research, you discover that this is not a new thing. And that's why when I introduced options in the first module of the course, I kept it so high level and abstract. There's strong evidence that people have been trading these things since antiquity. And it kind of makes sense, right? If you go back to what and why an option is, you can imagine if you were a date merchant in Babylon, you might have wanted the right to buy dates if the market price was higher than a certain price. Like you might go to a trader, and by this I mean a physical trader or a farmer, and you might make a deal that says, hey, if it's higher than this, I'll pay you this, and today I'll give you some money just for that right. So you basically bought an option. We know with absolute certainty that things like this were traded in the 16, 17, and 1800s. So people have been doing this a long time. People have been doing this before people really understood probability. And that's something that was, people talk about those mind blown moments, right? One of the mind blown moments I had was when I really started to dig into the history of human thought as it relates to statistics and probability, and to realize that we've only been thinking in probabilities and we've only been seeing with statistics for a few hundred years. And now, of course, I live in America, and anything that's older than 100 years here is very, very old. And some of you come from parts of the world where we have quite a different perspective. At least we know people have been writing for 6-ish thousand years, and for nearly all of that time, people thought in a very deterministic way that the gods made something happen. And this idea that outcomes could be ruled by chance was a radical revision in the way humans saw the world and understood how things happen. But the interesting thing is, even before that understanding of probability, it appears that option traders did a pretty good job figuring out prices. And this is an important lesson for us today, because one of the mistakes, and we'll talk about it more in a moment, one of the mistakes is to really look for the best model to try to figure out some secret that people are missing. And the market doesn't really miss a lot. So in this world, before people understood, not only people didn't understand pricing, but they didn't understand chance and probability. How did people get to option prices that were basically right? Well, just by the market. The market is a marvelous and magical thing, and what it relies on, there's a very interesting book that is called The Wisdom of Crowds. I know many of you have read it. If you haven't, I would recommend reading that book. But the idea is that if you have a big crowd of people that are trying to figure things out, what you will typically have in that group is a few people that have a pretty good sense of what it should be worth. And sometimes they might be experts. Like a classic example is if you have a farm animal and people are trying to guess its weight. Well, most people looking at it will have no idea. And so some people will guess very low, some people will guess very high. And on balance, those uninformed opinions cancel each other out. So in other words, you have just about as many people that guess ridiculously low as guess ridiculously high. And if you average ridiculously low and ridiculously high numbers, they cancel each other out. And then you will have a handful of informed people who understand the problem, who can figure it out, and their opinions, that's really what a market is, right? It's a market of opinions and perspectives, will tend to push the thing toward the true, quote, the true answer. And this appears to be the way options work, and they work very, very well. Now, I would suggest also we would have a lot of trouble trading in a market like that, because here you're really trading against the experts. And I'm sure there's no transparency because you went to a merchant to get a quote on an option. It just wasn't the way it worked, or you have no idea what people were giving you. So how could we figure it out if we wanted to figure it out from scratch? And by the way, the last point here, if you start reading about options, you're quickly going to run into a lot of equations, and you're quickly going to run into a lot of math. And there are good reasons for that. One of the reasons is that options pricing is really about how the price of the option changes as other things change. Now, I use the word change a lot, and for those of you with a little bit of math background, right away you're thinking calculus. And this is, in fact, why calculus is important in options. But you don't need to actually touch the math to trade options, but you need to understand the intuition, what people are measuring, that you're measuring different things changing in response to other things. That's why it's a little bit more difficult. And options tend to be a little bit more cerebral or intellectual or quantitative than many other instruments. But just know that if you start to read about options, it's going to probably seem a lot more complex than it is, because like we could go through and name the brightest mathematicians, and a lot of them were drawn to finance problems at different points in their career, and many of them specifically were drawn to questions about option pricing and optionality and probability. So it can get pretty thick. It doesn't need to get so thick. So one way, if we sat down and talked about this casually, we might think like this. We might think, okay, so there's a timeline here, and the timeline ends at expiration. Now, we said we know what the option is worth at expiration, right? And we also, what do we know? We know what the option is worth at expiration, and let's talk about the stock price. We know what this stock XYZ is here at $100 today. And we might think about the way the stock price might move and might develop to expiration. We realize that a lot of things could happen, including just everything from radical trends, but we would realize that it's probably more likely that we end up kind of somewhere in here than at an extreme. And already, just casually, this would help us get some, is it more likely that this option is going to be worth $1? Or okay, let's do this. Actually, I hadn't planned this, but let's think about 3 scenarios. And again, I like to stretch things to kind of stupid extremes because they're not so stupid. Is it more likely that the option is going to be worth plus $1, minus $1, or plus $10,000? Which of those 3 is more likely? Now, I'm not sure I can answer that question, but let's ask a related question. Which one is less likely? And it's pretty clear that this one is by far less likely. And of course, then we could carry this down to get different scenarios. And in fact, one of the ways that we price options is on something called a binomial tree. And what you do is you run many simulation paths through this tree, and you find where the price ends up. You figure out what the price of the option would be. And there's one other piece which I won't talk about too much, but it's kind of important, and technical traders especially don't think of it because it's kind of abstract finance, but time value of money, meaning that if I give you $100 today or $100 a year from now, which is worth more? And it's not a question of me giving you $100. Let's say with certainty, so there's no uncertainty about me paying you in $100. I'm paying you the $100, but it's just I'm going to do it either today or a year in the future. Well, it's worth less a year in the future. And the intuition is, if nothing else, what you could do is take that money I give you today and you could put it in something where you could earn interest. In today's world, maybe not a lot of interest, and paradoxically, in some parts of the world, negative interest, which is an entirely new concept in the past 10 years. But this is the idea that if the option is worth $2 at expiration, what you then have to do is figure out, well, wait a minute, I'm making this trade today, so you have to adjust this back. We're not going to get into the math behind that, but that is if I think about my perspective as a technical trader where I knew nothing about actual finance math, and then when I started studying this stuff for real and understanding it, this was one of the revelations to me. And it's one of those, oh, okay, of course, it's intuitive, I get it, but until somebody says it to you, it's probably not something you're going to magically figure out yourself. And it is one of the cornerstones of understanding how people value things and how people think about valuation. It's important, but we don't need to get too sidetracked with it here. But just understand that this idea of running a lot of kind of weird simulations, which I've shown in a very clumsy way here, and to really do this, we need to have good ideas about how stocks might move. And ooh, there's a key. We'll come back to that. And we need to run, not hundreds, but thousands or tens of thousands of scenarios. And it gets to be a little bit difficult if we're doing it on paper. So this is one thing the computer has given us, and we'll talk about that. You can do a simulation. By the way, if you have questions, type them in the question box. I will select the questions. I'll try to stay very on topic with the questions. So it's possible you may ask a question that does not get answered here today, but I will probably wait until the end to answer this question. Somebody, Christian, has just asked, how can we trade options if we don't know if a stock's going up or down? And that is a question that we're definitely going to get into here right now, basically. So Black-Scholes, you all know about this. I imagine everybody here has heard about the Black-Scholes model. Just know that this is one answer to the question that I posed for today's session. What is an option worth? It's one answer. It's not the only answer, and it's not the final answer, but I do think, and we're not going to spend a lot of time on it today because it is a little bit more theoretical, it is a little bit more abstract, but when you have more time, and if you are interested, a good example is after you've kind of absorbed everything you need to trade, and you go through this period of intense education that takes weeks or months, and then you kind of reach this plateau where you're actually executing in the market. Maybe it's just paper trading, but you have your idea together and you sort of feel like you're done learning. That's one thing that happens when you learn to trade. It's like you're just drowning in information and new ideas at first, and then you reach this point where you sort of scratch your head and you say, oh, wait a minute, like, have I learned everything? Am I done learning? And you don't really know what to learn. Well, when you get to that point where you feel the information flow is slowing down, this is the time, I think, to explore some of those avenues that might make you a deeper thinker, might make you, quote, a better person, whatever, I mean, I'm joking by that, but really might satisfy your curiosity and might fill out your understanding of those concepts. And one good area to study and read about is Black-Scholes. And again, depending on your mathematical background, you will either find this quite easy to understand, or there will be some aspects of it that will be outside of your ability to fully understand. And I say that because that was certainly me when I started. I could never understand some of the assumptions in their full, the full implications of those. But you can still, it's very interesting to read the story. And this is very important. A lot of people are dismissive. I talked with a guy in a Facebook group who was basically trying to recreate the wheel. And I said, well, you should understand Black-Scholes first. And he said, oh no, that was created by an economist, and economists don't know anything about the market. Well, it was created by some gentleman who won the Nobel Prize. So that tells you something about how important other people think this work is. This is profoundly important work. And Black, by the way, did not get the Nobel Prize. He died before, and they don't award the prize posthumously. So that's kind of a sad little footnote there. But I guess the story is, if you're going to do something to get a Nobel Prize, get it before you die. Do be aware that this is, a lot of people will talk about Black-Scholes or other models as if they give you the answer. You go to the market, you go to a web page, you plug things in, and you get the answer. No, this is a model, and models rely on assumptions about how the world works, and it's really important to understand those, particularly to understand the blind spots and the places where these models come apart from reality. This points directly to some ways that we can make money. So that's to me kind of exciting. But again, these models do typically work pretty well, very well, or very, very, very well. And I would also encourage you strongly not to get sidetracked into the model trap. And this is, most of us go through this at some point in your career. You're going to think, I can do this better. I can figure out some model that's going to give me the best price, what an option should really be worth, and then I'm going to go trade this model against all of these blind people who don't have the wisdom and insight of my model, and I'm going to make a ton of money. It's not really the way the market works, because if you go back to that option market in antiquity, the prices were set by market forces. And this is one of the ways that traders kind of have to twist their head, because the market is, the options are worth what the market says. And if there was some horrific mispricing, then yeah, people thinking like that would be wiped out of the market. So there is no persistent horrific mispricing, and spreads are wide. So it's not that uncommon. You might see an option that is, say 230 bid at 295, and we assume the actual value is right at the midpoint. For calculations, that's how we do it, but maybe there's very different size on the bid and offer, different depth of the book, and maybe this hides some other true place. Maybe you have a temporary distortion in some strike. Somebody comes in and does a big trade in one strike, and it pushes the price of that strike up or down a lot. So there can be all of these momentary distortions. The market's a lot noisier than a lot of these models would assume. And you'll see tons and tons of models. Many of you, of course, Bjerkson Stensland, you're familiar with, because this is the model that theoretically fits at least call options for American options, basically options on stocks, some of the Thinkorswim platforms, where you might have run into that. But there are tons and tons of different models, and this really is not about finding the best one. Because if you think about the goal of the model, it's just to tell us that if we sell a lot of options, and here we are going back to that idea of you need to do a lot of trades, you need to think in a large sample size, and you do it at the prices given by the options, and if the assumptions of the market, of the model, are correct, and assuming no friction. So what this means is we can really trade at the prices, and you can't, and there's no transaction cost, there's no financing. Of course, these things aren't true in the real world, but this is a model. And if all of these things are true and we do a ton of trades, then we'll break even. Not profit, we'll break even, because the model will give us the fair price. The model will tell us what the thing is worth. And this is important because there has to be a market. If you, sure, I can tell you what price would be a good price for you if you want to buy an option. You buy it as cheaply as you possibly can. But of course, you're not going to have an ongoing market, because nobody's going to be able to sell you options as cheaply, as cheap as they possibly can. They're not going to take that risk for all the reasons we've already talked about. So if this is true, if with option pricing, what we're really getting into is that fair price at which it looks like nobody will make money, how do we make money trading options? What's the point, right? It's a fair question. We'll come back to that. Let's think about a couple of these assumptions about price. Almost all models will include some variation of these assumptions, particularly the first one, which is that price moves randomly, and that price follows a normal distribution, or if you have more math background, returns are log normally distributed is the assumption in the Black-Scholes. And if that sentence made no sense to you, it truly doesn't matter. You know, it's a degree of depth into the equation that you don't really need to understand. But why are these assumptions made? Well, I think we can understand two things about these. You know, how good are they? Well, first of all, the assumption of random price movement is pretty good. And this is something that I get a lot of pushback on. I get, you know, particularly from beginning, I think it's from beginning traders who, if people get hung up in two places. One is, and I would say this is naive, and I don't say that in an insulting or judgmental way, but you know, if you come to the market and somebody teaches you a secret trading system, you think you have something that has great predictive power, and so you assume that, well, the market doesn't move randomly because I figured it out. Of course, that level of understanding doesn't often survive much contact with the market or actual trading, because you begin to realize it's harder than that, and that's okay. That's what it's part of the education process, the school of hard knocks. But then the other place that people get stuck is people correctly say, wait a minute, nobody trades in the market for a random reason. Right? Nobody gets up and says, I'm going to randomly push the buy button today on this stock. Everybody who buys or sells or even puts in a bid or an offer, they're doing that for some reason. It's not random. And this is true. But where people miss is the idea that a lot of people can be doing things with intention, but they can cancel each other out and the end result can be random. A good example, I think, and one that I've seen turn the lights on for a lot of people, is to imagine you're feeding fish. So you have a bunch. I'm not an artist. I don't know if you were aware of that, but you're going to be today. I am not an artist. You have a bunch of fish and you're throwing food into these fish. And then think about that. Have you ever seen that? What happens? You have all of these fish come up and they try to bite a piece off of the food. Now, each fish is bumping into the piece of food with intent, right? Each fish wants to get a bite. Each fish wants to eat. That's actually pretty good parallel to trading, right? But it's probably not too hard to imagine that if you were to just trace the path of that piece of fish food, that you could see it might move pretty randomly. You know, there might be times that all the fish get from one side and the food goes in one direction, but you know, so you don't really know, like, what's the path of the food. It might look like this, it might kind of look like this, but if we did this a lot, let's say we threw a piece of food in and graphed it hundreds and thousands of times, we would probably not find a pattern to how the food moved, would we? Well, unless there was, the stream was drifting, right? That's another parallel to the market. But so this is important, and the reason I just spent a couple minutes rambling about that. Somebody says it looks like a hump. Okay, so they're whales, whatever. I'm feeding. I won't even. You can't shame me with my art because I know it's so bad. You can't. So don't even try. And my handwriting is actually probably worse than my drawing. We all have skills, and some skills we don't have. But the other one is, and this is kind of interesting, that price follows a normal distribution. Now, I do want to talk a little bit about the normal distribution, but not from stats class, because if you've had a stats class, you've learned about like rules of thumb with standard deviation and things. And what I want you to know about the normal distribution, it's just, first of all, kind of this intuition that this is what is called a bean machine, or I think it's also called a Galton box. And it's a physical, it's an interesting physical analog, because if you can imagine swinging it, so like change the axis, rotate this down, and then imagine that these are stock prices moving forward through time. See that? So if you just kind of tilt it, and so rather than falling down and going left and right, they're going to the right, moving up and down. That's what happens with stock prices. But what you would see here, if you followed each trace, is a random path. And some of the beans end up completely outside of the box. And gosh, that's kind of interesting from a finance perspective too. But you do find that far more of them end up in the middle. And that's kind of interesting, right? Far more of them end up in the middle, and then some end up on the very extremes. And it does follow a curve that looks, well, not quite like that, but something like that. And this, we can't predict where any individual bean is going to go. You know, when this bean drops, like we don't know if it's going to end up here, if it's going to end up off the edge or somewhere there. But we do know if we do this with a lot of beans that we're going to end up with a lot more here than we end up here. And in fact, in the physical world, you do this a lot. You find it magically follows the normal distribution. There's no magic to it, but that is the way it works. And this, to me, this was another, and I know that all I can really do is share and emphasize some of the points that really opened my eyes. And yes, I came to the trading world without understanding any of this quantitative stuff. And I think I gained a fairly deep working understanding of it. And so, you know, I can show you the points that were really pivotal for me. If you have a better quantitative background, then you're already steps ahead of where I was. But still, knowing some of these things may show you something to think about a little bit deeper. And one of the things that really was a huge aha moment was when I thought about the future in this probability cone. And I remember I thought about it late at night, and I used the example in my book, which several people have said this is such a powerful example. And you imagine standing on skis at the top of a hill, and you look down in front of you, and you don't know where you're going to end up. But you do know if you go down this ski slope and kind of take, you know, random turns that you will end up straight underneath where you start a lot more than you will end up at the side. This is a variation of what people call the drunkard's walk. And you know, that's actually a mathematical model where you imagine a really drunk guy after a night of maybe with a bottle of absinthe. No personal experience there, but that you know, you have this very disciplined drunk who has no, first of all, he doesn't favor either leg, and each step is equally to the right or left. And if you graph his price, if you graph his path, you end up with a pretty good model for how we think price moves, which is completely randomly. And it was, so the revelation for me was understanding and applying this to price, that in the future, we are much, much, much more likely to end up where we are here than to end up either higher or lower. And particularly from a technical perspective, you know, I might see patterns here, and I might say sometimes, oh, you know, well, I really think we're going to end up down here because, you know, whatever, or I really think we're going to end up here. So again, we get this false sense of certainty because of the analytical framework within which we're seeing the market. But from a statistical perspective, from which I think in many cases points toward a reality, we're a lot more likely to end up here. And in fact, we're, you know, much more likely to end up here than you are here. So it's this idea that though the path is highly uncertain, you have no idea what's going to happen in the future, you do have some idea about what the average outcome could be. And then an extension of this is you have some really bad surprises, right? You know, if you take this cone and move it back to here, where you might have been predicting a cone like this, and you got an outcome like this, or down here, you know, maybe your cone looked like this, and you really didn't see this coming. So sometimes we get some huge surprises from markets, but this idea that we know outcomes within a likely range, that really turned the lights on for me. So what the lessons I took away from this is that the best estimate of the future price is today's price. Now, we do know, for instance, on average, stocks go up about 7 or 8% a year. Might differ depending on market cap, but in reality, this, you see the zero line here is flat. For a stock, don't measure afterwards. I have no guarantee, but it should be tilted slightly to the upside. because there is this persistent upward drift in stocks. And that, by the way, is true even in a rip-roaring bear market, that your theoretical probabilities still skew to the upside. This is not necessarily true in a commodity or currency, but it is necessarily true in stocks or stock indexes. Best estimate of future volatility, and this is a dirty, dirty word today, okay? We're going to spend the entire next session, which also will be publicly available for everybody to see in archive, but we're going to talk about volatility for a whole hour. So that's quite a big deal. Just understand that the best estimate is probably somewhere around the current volatility. We'll talk about ways to model that and do a little bit better sometimes. And again, outcomes likely, we can predict the likely range, but there will be some big outliers. And the biggest thing here is we're learning to think in uncertainty across a range of outcomes. Now, a lot of you know the Mark Douglas book, right? This is what I think the genius of Mark Douglas's work is, that what I'm describing here, again, if you have a background in probability and statistics, I'm not saying anything here that is revolutionary or maybe even that interesting. I hope you wouldn't say that, but it's nothing new if you study statistics and probability. But what Mark Douglas did was to take those rather elementary, fundamental, basic lessons of probability and apply them to trading outcomes. And so you're seeing we're actually stepping back a step. We're not thinking about your trading outcome, but we're thinking about market movement. There's a lot of wisdom here. It's really about the fat tails, not those tails, these tails. And this is standard deviations, and this blue curve here. So there's also, by the way, which I'll say on the next slide, you need to be very careful. A lot of people will see anything that kind of, people know this is the shape of the bell curve, and they will say, you can just tell by looking, right? And I've seen people do this work, and they'll graph things, they'll create histograms, and they'll see this bell curve shape. And a lot of casual, there's a lot of very, very weak stats work out there, particularly the people who are generating a lot of market stats. They don't understand statistics there because they're just generating, basically headlines they want people to click on. And so the reason I say that is because this is being taught in some places that if you see this hump in the middle, it's a normal distribution. Well, no, not necessarily. In fact, a lot of probability distributions look like the normal distribution. But what you see here is your standard, I shouldn't say standard, but your normal distribution, which is the typical bell curve people talk about. And then one that doesn't really look that different. It's called a Cauchy distribution. If you look, like, the shape's kind of the same, right? And for those of you who know the math, you know that what I'm showing you here is one of the craziest and most intractable probability distributions. In fact, the red one actually has no defined mean. And there's a great example of this in the Mandelbrot book, The Misbehavior of Markets, which everybody should read. I do feel like a lot of these lessons people knew better 10 years ago, but we've had some pretty benign trading conditions in markets, and a lot of these crazy things are kind of forgotten. But Mandelbrot gives this example of putting somebody in front of a wall and throwing darts, somebody blindfolded. And the guy doesn't know where he's throwing darts, but most of them are going to end up kind of right in front of him. And if you graph them, they'd follow a standard distribution. What it is a normal distribution. What it is basically another type of physical analog of the bean machine. And then he said, well, compare this to somebody standing in front of that wall with a bow and arrow and swings radically before each shot. And you don't know, is the arrow going to hit right in front of that person, or is it going to hit so far down the wall? Is it going to be parallel to the wall, so it might not, in the physical world, ever touch the wall, but might hit miles and miles and miles away if he has a magical bow? I guess I don't know, whatever. But this Cauchy distribution actually explains a lot of things we see in the market and crazy possible outcomes. So what are the lessons from more events ending up in the tail? Well, as I said, a lot of things look like the bell curve. Small differences in the shape, you cannot do this visually, make a big difference in the outcome. But with these fat tails, two things are true. And this is the point. Extreme events happen and happen quite often. So when somebody looks at something and says, this is a 1 in 150,000 year event in the stock market. Well, what they're doing, what they actually mean is if things were normally distributed, and they aren't. Basically, pretty much nothing in the market is. So these events are not crazy. I can show you 35 sigma events in the Dow Jones index, which if you had stats 101, that's impossible. It's not impossible, but it's so extremely unlikely that if we were generating price bars since the beginning of the formation of the universe, we probably would not have seen that event. So it's not impossible. It effectively is impossible, but these sorts of crazy things happen with remarkable regularity. And that's because if you are thinking under this normal bell curve, you're using the wrong model. Whoa, hello. Did you catch that? If you're thinking under this normal bell curve, you're using the wrong model. And this normal bell curve is one of the assumptions of those options pricing models. Interesting, right? We'll get back to that. And the other thing that people don't realize is, so compare the red curve to the blue curve. Look, you have extra weight here. Do you see? It's like, imagine you have the same volume underneath the curve. If you get the extra weight here, where does it come from? It comes from here. Do you see that? The blue curve is higher here, which means two things. It means that you do get events out here. So you have, and in terms of, let's just say market movement, this would be a very big upward move in a stock. I'm going to say stock, but it could be anything, and a very big downward move. You have things that happen here, big ups and big downs, that if the normal distribution were true, should never happen quite frequently. But the other thing is, if we're going to push things out here, it has to come from someplace else. And where it comes is the moderately big moves. So we actually end up, in many cases, this is higher. So we end up with a lot more events around the mean. Now, it's kind of a 1-2 punch in the face, because from a market participant standpoint, and what I'm showing you here, and I know we got pretty far into the weeds statistically, but I think this is important. Here's the 1-2 punch. What this means is most things are going to be very boring. You're going to have more things that cluster in the middle. And then you're going to have more crazy extreme things that you're basically going to have things happen that you think never should happen. We'll talk more about that in a moment. Hold on to that. We'll come back to it. And again, as I put here on the slide, back in the financial crisis, 2007, 2008, 2009, people were talking about these things, and even in the major media, which generally tends to be kind of sensationalistic, a lot of these concepts were being discussed, and everybody knew about these things. I fear that these are lessons we've forgotten in the past 10 years. And the market will remind us, we will be taught again. There will be a time when people are saying, hey, go read this Misbehavior of Markets. Why don't you read it today? So it's probably an $8 book on Amazon now. But why don't you prepare yourself, because sometime in the next 5 years, we're going to see some serious market stress, most likely. And these lessons are really going to apply them. So put yourself in the perspective of an option seller. And let's not name names, but we all know that there are people who focus very heavily on selling options. In fact, and I think this is one of the lies out there. People say you should do nothing but sell options, and then there are reasons why. We've talked about some of that in the first module. But if you are an option seller, what this means is this fat tail thing. And remember the two lessons, right? More extreme events and more things in the middle. Well, what this means is you're going to win a lot. In fact, it's not really that hard to structure a to structure an option selling program where you win 85, 95% of the time. And this is, if we go back to this, let me clear my marks, it's because what this actually looks like usually is something even a little bit more like this. Compared to the normal curve, you have most things that kind of stick in this nothing happening, very, very quiet. But then you also have gigantic tail extremes. And if you do sell options with open-ended risk, and you do this for many, many years, unless you have very good risk management and you're a little lucky, you will go broke. Why? Why must this be true? Because if this is not true, what you're assuming is that option prices are wrong. And that is, in fact, one of the things that people would like you to believe, that everybody always and consistently overpays for options. But if that was true, you wouldn't really have an options market. So it makes more sense to assume that prices are pretty much on balance fair. This is what I just said. If you've never thought about it, this you should kind of be holding your head and going, oh wow. If what I've said hasn't really made an impact, then I have not said it very well, and I apologize for that. But I would encourage you, go back on the replay and look at these last 5 minutes, listen to these last 5 minutes again, and understand how you might see with a very, very high win ratio, and you might have to trade for years. You might trade 3, 4, 5, 10 years and not see this crazy tail event, but it will happen, and not just in natural gas. It will happen in an individual stock. And if you have open-ended risk, a single trade is enough to take you out of the market. I have a question here. Does the look back affect the shape of the bell curve? Look back is a 20 bars as opposed to 250, or let's say thousands or tens of thousands in some cases. I think anytime you take a slice of the data, and a smaller look back period is a defined slice, you're going to have more variation. And because you could just get lucky, right? If you have that grab bag that has an even number of red and black marbles, I don't know, you could reach in and pull out 5 marbles and they're all red just by chance, right? It could happen, but you're probably not likely to pull out 500 marbles that are all red if there's an equal number. And what you see, the more market data you have, the more you start to see the quote true underlying shape of the distribution. So rather than, yes, you certainly could, if we went and identified areas where, say, the market was in an uptrend, well, you would find the bell curve has a certain shape, or in a range, or when volatility is expanding or contracting. You definitely could isolate, that's post hoc, right? Because you're looking at what's already happened. And so there's not much value there, I think. But if you look at a large sample of market data, then you start to get more to the the true underlying distributions. Okay, let's go back to these examples and think about, rather than trying to figure out which one of the what the price actually should be worth. That's kind of how I set up the question. We already did this, right? I said which one we would pay more for, and that is easier to understand because I'm looking here to make sure I check the right ones, because it really is about that idea of uncertainty. And if the strike price is closer to the stock price, then the option is more likely to be in the money. More time, more volatility makes the option worth more. And this is the driving understanding that needs to be behind all of your thinking about option valuation. That the more likely it is in the money at expiration, the more likely it is the more it's worth today. And these are the big 3 factors that we think about: the distance, and by distance here I mean the relationship. So a lot of models will tell you that they'll break this out into 2 factors: a strike price and then the price of the underlying. Well, you also can just think of it as the distance, how far apart those are, and distance and moneyness actually. because you could have something very far out of the money or far in the money. But it's this relationship, I actually probably need a better word here, it's this relationship of the strike price and stock price that matters. How much time is left and how volatile it is. Very interesting. This is trivia, and don't get too sidetracked in this, but these can end up being basically equivalent, which is another mind-blown moment. But what else matters? So we're not going to talk about these, but dividends, there are cases. It's important to know that these are out there because there are points where they matter more, and where it matters more is when they change a lot, of course, right? Over the past 10 years, interest rates have basically never changed, so you don't really need to think about the impact of interest rates on option prices. If, however, we got into an environment, and in the future, that will happen, that let's say interest rates are swinging dramatically and changing a lot from week to week, then it's going to have more of an impact on your options prices. This is more of, in the current environment, it's more of a concern for professionals. There are ways you can trade the interest rate. Interest rates will have an impact on a lot of, again, not to get too far into the weeds with weird things, but whereas a smaller trader, we typically get out of trades by just unwinding them, right? If I sell an option, I'm going to buy it back. If I buy an option, I'm going to sell it. In some cases, maybe, I'd hold it to expiration, but basically I just do the other side of the trade. If you're a professional, you don't always have that possibility for a number of reasons. Maybe you get stuck with a position. Maybe I, the big retail trader, wanted to buy a bunch of certain strikes, so you had to sell it to me. And you can't really unwind that position always. So you, rather than unwinding the trade, you'll hedge it. You'll create various trade structures that should theoretically have no price movement or no risk. And many of these are quite sensitive to interest rates, many of those structures. So if this, let me say, this does not apply to you. If this applied to you, you would already know exactly what I'm talking about. But you certainly could be in a situation where interest rates make gigantic swings and a lot of professionals are struggling to adjust things. It could cause distortions in the market. You need to know. Dividends, there could be a big change in dividends that could affect option valuation. So it's out there, but I think from your day to day, the three that you really want to focus on are the three that I have dimmed out here that I had on the first slide. Also understand that the price is forward looking. So what we're also talking about is the market's expectation for changes in these factors. A great example, a great practical example is if you have a stock that isn't moving at all, you might go and look at the option price and you might see the options are getting more and more expensive every day. And that seems very counterintuitive, especially given what I just told you here, that, right, if there's more time left, the option is worth more. Well, day to day, every day, there's less time left. Time's not flowing backwards. So how can this option be getting more expensive? That's one, it does happen. And, I would like to, you may know some answers, but if you don't know some answers and we were sitting down, I'd make you think about it for a long time. But I'll just give you an answer. Might be before earnings. So you could have a stock where the price isn't really moving, but the market thinks the thing's going to have a big move or knows earnings are coming and there's a potential for a big move. And so people who are selling you those options, they want some protection from those price movements, so the price of the option goes up. That's quite typical. Mental trick for valuation is to think in three scenarios: up, down, and flat. This is something we're going to come back to in the course, and it's really actually, it sounds cumbersome if I say 5, but it really is 5. So you imagine that the price is flat, goes up a little bit, goes down a little bit, or you have these kind of big outlier ups and downs. If you think about any valuation situation, and you put it through these scenarios, you end up with, this is a good way to drive toward having some intuition. And I apologize, I just looked at the time, so we're running actually a little bit late. Okay, so here's the Black-Scholes equation, which I had to show you to scare you. We're not going to talk about it very much, but you won't ever need to work this. You could structure your options career so you had to work through this equation, but you don't ever actually need to see this thing again, because from a practical perspective, most of the time you're not even using a calculator. In fact, we're going to use a calculator here at the beginning a little bit to understand theoretically how these things move, but most options traders, I feel pretty safe in saying, go most of their lives without ever using an options calculator. However, look at this. What I've done, I've tried to get an answer for our $100 call with a $100 stock. And I made some assumptions. Look here, both these models, same date expiration, same interest rate. But just by changing the volatility, which again, blatant plug for the next module, and that's the topic I'm really excited about, look at the difference. So this is a huge, particularly in a percentage, look at this as a percentage of this. You can get a dramatic range of prices just depending what volatility we plug in. And the question, of course, is, we knew what the stock price, we knew what the options price, we knew all of these things, but we don't really know what number to use for volatility. That's quite interesting. Okay, takeaways. So if nothing else today, I've shown you that valuing an option is not simple. And it's very easy to pull up an options chain and say, okay, here's a bunch of prices, but when you think about what goes into those prices, that is a combination of all of the reasoning that we've talked about today with market forces, with people buying and selling these things. You can't just take the prices for granted. Like, it's kind of cool if you think about it like that. The most important factors are not that complicated. The relation of the strike price to the price of the underlying, the time left, and the volatility, which, maybe that one's a little bit complicated, but it's really not, you don't have to deal with 15 factors, right? You don't have to deal with all of these crazy, if you're doing fundamental analysis, you got to think about all these things and all the things you don't know and all the ways you're going to get blindsided and what is going to be very obviously important months from now that wasn't obvious today. That's your fundamental macro perspective. But as an options trader, you got a pretty small universe of things to worry about, so you know what to worry about. There are many models and ways of evaluating options, but it really doesn't matter, because what matters most is the observed price. And we haven't talked about that much, but when you go to that options chain, what does the market say the option is worth? And then the relationships and how things change. The whole idea behind pricing is to find that fair price. So don't get stuck thinking you're going to find a model that's going to give you some secret true price. The price you see in the market is pretty much the right price. Volatility is really important, potentially confusing. I'll clear up some of that confusion for you soon. And this is really extremely important. It's one of my tricks, mental framework for thinking about technical problems and for thinking about option valuation, but just thinking in these 5 scenarios. And as we work through the course, we will be returning to this, but I think it's a very powerful tool. So how do we profit? I just want to spend a couple minutes on this. Well, in the unlikely event that you find a mispriced option, there are opportunities for profit. But even then, if you wanted to trade it, it's not as simple as finding a really cheap call and buying it. You typically have to spread these things off. There are people that do this, and they do it with computers, and it's done so fast that if you're the at-home trader, you're probably not going to find these things, and you're probably not going to compete. I wouldn't waste time thinking about mispriced options. Now, hopefully you're several steps beyond where I was, but when I started, I was thinking a lot about this. This was my hope, to find mispriced options. Just doesn't happen. That's why I've emphasized here so much about the market being fair and smart, etc. If the future diverges from assumptions in the model, I cannot possibly emphasize this one enough. The assumption is that given the assumptions of the model, random walk price movement, blah, blah, blah,
every option is fairly priced. Well, if those assumptions are wrong, if, for instance, we could discover some technical factor that would give a tilt to the future price direction, then all of a sudden every one of these fair options is in fact mispriced. And that's a magical thing. But it's not the same thing, understand, as a model mistake. Here's where we're applying a directional trading system. I'm saying this in a very quantitative way, but this is where we apply a directional system to model prices. If something surprises the market, or the underlying moves in unexpected ways. Unexpected ways could be, we expect the price will kind of bounce around. Well, unexpected ways could be a straight line. Unexpected ways could be a big spike or something like that. But there are lots of ways that the market could move with subtly that would violate the random walk assumptions, the price model. That's the whole point, by the way. I did, and I hope that, and you can let me know, send me an email. I hope this connects for you. I didn't want to get too theoretically into the idea behind random walks and models, but I do think it's super important because this is how we actually make money with options. By finding these points where the way the market moves in the future, the likely future outcome is actually different from what the model thinks it is. That's where we have potential for profit. Up next module is going to be volatility. And that will really give us the missing piece from our tool set to answer most of the questions we have. Maybe even all of them to some extent. Where do you get more information? Follow me on Twitter at Adam H. Grimes. You also can check out my blog, adamhgrimes.com. I would love for you to check out marketlifetrading.com. There's a gigantic free trading course. There also is, there are a couple premium services there where you get to see my daily market analysis. You get a bunch of screening tools, and I'm really soft pitching this, but I'm very, very excited about what we're doing there. There's a free trial. Check it out for a couple weeks and see if it clicks for you, see if it works for you. For some people, it has been a very, very, very useful piece of their trading process. So go to marketlifetrading.com, check it out. I will say this, we don't offer an explicit discount code today, but if you take the trial and decide that you want to continue, send me an email and Tom and I will finagle a special discount for you. So marketlifetrading.com, go check it out. And if you aren't interested in the premium services, it's not the right time for you, there is a free technical trading course that you absolutely should go to. It's 30 hours of video, hundreds of pages of PDF exercises. Check that out. And you can reach me, email adamhgrimes.com. I will see you back. It'll probably be about 2 weeks. Check for an announcement. I'll send you an email and we will do the volatility module. Thank you very much. I appreciate your time today.